Don Kaufman here, September 10th, 2021. Seconds left inside of this trading week. Doing the TheoTrade weekend update here on a Friday afternoon. Why does some mild sell-side activity feel like absolutely massive risk? I mean, again, the bell's going to go off here in just seconds, but net, we're down 0.8%. Nevertheless, some pretty consistent sell-side activity after hitting all the way up to 45.10. Here we are facing the closing bell, and there's days like this where that closing bell just cannot come soon enough. Broke under the 44.50 handle, and we are just going for it on some decent size. But again, net, right? This is a relatively mild move, but there are definitely some closing bell. There are definitely some incredibly important points, though, to be taken away from some of the sell side activity that we're seeing presently. And look at this, even after the closing bell, futures are still open and going for it. Let me bring up a few points here in a market update, and we'll move forward then into why some of this mild sell side activity really does amount to some massive risk. First and foremost, let's jump over to the SPX, the mother of all products. All right, in the SPX, we are now looking at a weekly. To remind everybody, SPX, the mother of all products, the expected move in this shortened holiday week of trade. Remember, we're on a 4-day trading week, was plus or minus approximately $50. Where did we actually close? Well, again, the bell has literally just gone off, and we are definitively outside. Okay, so we've had a lower expected move breach specific to the SPX. And that means a tremendous amount. In fact, to show you how rare this has actually been, if you take a look back on the SPX chart here with me. Now, this SPX chart happens to be my hand-drawn SPX, right? Expected moves. In effect, when I hand draw these, it's to be absolutely, accurate down to, the penny of an SPX move. In fact, we'll talk about this here towards the latter portion of this video, but I'll be able to actually grab the expected move for the coming week, which I'm actually highlighting here momentarily. Right now, the SPX is not closed, right? The SPX trades 15 minutes after the bell, so the $112 expected move for the coming week has not yet completely settled out. Nevertheless, back to the edge over here, just to display to you how rare it has been recently to see an SPX breach to the downside. You can start, at the beginning of the year. We've literally had one breach here. Okay, this is a mild 2 breaches, right? And as you actually scroll through this, you can pretty much count on one hand, there's 3 breaches, to the downside of the SPX. This is the 4th breach to the downside in the entire year inside of the SPX. Does this one feel any different? No, not necessarily. But there's nothing to be discerned from here other than, all right, so we broke to the outside of the expected move, which the expected move is nothing more, than what we think of in terms of standard deviation. So here we have a trusty little standard deviation curve. This is just expected move. So we're supposed to stay inside of this range 68% of the time. Where did we end up this week? Outside the expected move. Nothing to see here. Nevertheless, I'll explain why, things do look a little bit different this time here momentarily. All right, the next aspect, and I think this is really notable and definitely worth the mention. If you take a look at the bond market. Now, on last weekend's update, I talked quite a bit about the bond market, how we really feel that the bond market is going to be the big player in the room. Effectively, what I'm saying is, the bond market is likely to be dictating to the S&Ps, for the foreseeable future. In this particular case, though, what is absolutely perplexing and maybe a little bit downright scary, and this is what changes my feeling right now about the S&P 500, but you're seeing a little bit of sell-side activity inside of the bond market. specifically today. Now, for those of you that don't speak Bond Geek, it's about 28 ticks, 27, 28 ticks. 32 ticks happens to be a 1-point move. And a 1-point move is a decent sized move. But as the bonds move down, the interest rates move where? Up. So if interest rates are moving up, the question then lies, why are the financials, okay, a bit weaker? And this is where correlation properties, okay, apparently mean more right now than interest rates. In effect, what I'm actually saying here is that the financials, they had some sell-side activity today. In fact, when you start looking at auto expected move, okay, last week, the financials actually crossed outside their expected move. This week, the financials, they started, today relatively flat, but they're towards, okay, that lower edge of the expected move. What doesn't necessarily resonate very well with this, though, is that the financials are down with the bonds being down, okay? Why does that get a little bit scary? And I'll just give you the scary version of this. This is how, okay, liquidation events can kind of occur. And that is almost every asset class that you look at, all right, happens to be down. Like where are there positive points in here? All right, there's one for oil, yeehaw, okay, the dollar. But as we've mentioned, the dollar happens to be, if you will, almost like the new VIX to us. People have been buying dollar when they're scared and duck and cover and everybody goes into the dollar. So I don't look at that as a positive. I look at that as a negative. But almost all of your major asset classes are taking, okay, a pretty considerable hit. All right, nothing massive on a percentage basis. But again, this is where, some mild sell side activity starts to feel like some really, really big risk. That's one of the first aspects I wanted to cover over here. The other aspect with this that I really want to resonate with you, and I got to stress this to you. In my opinion, these bonds, okay, are at a very key inflection point. That if the bonds from here start to sell off any further, it is going to be a little bit of a tech disaster. And we're going to talk about tech here again in a moment. Why? All right. It just amounts to higher interest rates. Again, apparently interest rates, though, they didn't seem to play a role inside of the financials, but you can believe this, all right? If those interest rates start heading higher, tech is not going to like that, not even a little bit, because it would impede upon, well, first of all, their capacity to be able to borrow, but to borrow to be able to buy back stock, right? So I could go probably, 5 or 6 fold into reasons why higher interest rates will really start to damage tech in the near term. So the bonds selling off with financials down is a little bit peculiar because, again, it feels more like a liquidation event. But at the same time, to put in perspective, what are we liquidating? Huh? We're down like 0.6%. The next point over here to be made, big banks get bearish. Now, I'm not actually referencing the financials in this case. What I am referencing is throughout the course of this shortened week, right? So we hit September, and last week we even asked, is September going to live up to the volatility, right? And here we are, just a few days later, and things are starting to get a little dicey. But there were a tremendous number of banks that came out. Many of everybody from Bank of America to Goldman Sachs to Citi, okay, to Credit Suisse to Deutsche Bank, all had, okay, not just analysts, but we go all the way up the food chain to the CEO, okay, with very, very bearish connotations for predominantly September and October. I take that with a grain of salt. However, that is going to live, all right, in the presence of a lot of traders right now where they realize, well, the analysts are getting bearish, and that unto itself can actually cause, a degree of sell side activity. With that, okay, now we're going to move into something far more quantitative. All of this being said, again, it's a mild sell side activity. And one of the things I want to reiterate, one of the things I want to stress, okay, look at this like almost perfect symmetry in what's being sold off today. Now, again, I don't take this as being a positive. This actually looks like very much a negative, right? Nowhere to run to, nowhere to hide. Everything is moving okay, in almost perfect unison today on a percentage basis. Forget about this. Like, you just got to look at 0.7% across the board, okay? As I said, nowhere to run to, nowhere to hide. However, at the exact same time, okay, we're going to be talking about the monsters of tech here momentarily, because therein lies considerable risk. Before I get there, though, I think it's imperative to discuss the volatility futures, because here I am just downright bothered by the volatility futures right now. I'm going to show you exactly, okay, my cause for some concern. In the volatility futures, what we are looking at here happen to be the October volatility futures versus November versus, for instance, December. And there is what we kind of term a wicked, just wicked still, contango. Now, earlier today, and again, I'm going to explain what the contango kind of means, but earlier today, the distance between OCC and NOV, all right, was closer to $1.10. That distance has really narrowed all the way down to 65 cents. So we are right now, we're starting to get on the verge of a much more serious marketplace, right? And I'm going to get into, again, kind of every little nuance of this, because I think this is where that kind of mild selling can just literally flip and snap and turn into massive risk. And it's actually, again, one of the causes for concern. In this case, I'm going to cruise over to product depth chart. If you've never seen a product depth chart before, what you're actually looking at over here is a contango plot, okay, of the volatility futures. This is the October volatility future, November volatility future, and of course, December volatility future. It was exactly what I was showing you just a moment ago. So if I cruise back over to the trade tab, all we're basically looking at here is, you know, what? OCC is trading at 20, NOV is trading at 22 and change, but it's a cool way to kind of chart it, right? So what's the cause for concern? I'll tell you exactly the cause for concern. It still looks like this. I mean, you realize you saw some sell side activity, and the volatility futures, like, they haven't flattened out really enough. Now, again, as I said, the gap, the distance between here and here has closed, you know, substantially. You know, this was like $1.10, even $1.15 earlier today, and now it's 65, 70 cents. It's closed considerably. So what does this really amount to? Okay, things in a marketplace get serious, okay, when the volatility futures kind of either go flat or they even invert. So if you were to actually pull up this depth chart, the depth chart's not the easiest thing to pull up, but if you pull it up and the volatility futures look like that in the first 3 months, you know you are in it. You're just in some serious risk. And what I'm bothered by, though, is the fact that, you know, you had some mild selling over here, and the volatility futures, okay, they are literally like suppressing the move that could be in the S&Ps, right? And this is where in the S&Ps, and I'll just kind of script this up here, in the S&P 500, we can start to trickle down and trickle down and trickle down, and this will get a little tighter, a little tighter, a little tighter, which you got to be extraordinarily careful of, okay? Especially in this marketplace, it's going to snap, all right? It's going to snap. And the reason that we are mentioning this, a tremendous open interest, okay, is actually selling the near-term volatility futures and buying back month. And the trade, when I say it's almost like a suppression trade, there are so many people that are actually short near term, okay, buying longer term. And it's a great trade to be able to make as long as we actually stay in this kind of wild contango. But the second we start to get close, all right, where the OCC comes up to the NOV, what can happen is everybody that's actually short here will have to turn around and do what? They'll have to cover, and they'll have to buy, and the volatility futures will flip and they will invert. When the volatility futures invert or they even get close, what will actually happen, though, okay, is traders will start to see this vol skew flatten out. And the second they see it flatten out, they're going to come in here and they're going to sell, okay, a huge number of S&P futures, because that's their hedge. Before the volatility futures invert, they're actually going to start to pump sell orders specifically into the S&Ps. It is a highly, okay, quantitative trade. Okay, it's also a little bit of a convoluted trade. Nevertheless, it's the reality of what we actually face right now. And we need to watch those volatility futures very, very carefully in the near future, because again, the contango has been massive, and coming out of a massive contango could actually end up in shock and awe. And that's what I believe, eventually to get out of this, buy the dip, buy the dip. I mean, people are already counting on Monday, they're going to come in and buy the dip. You got to be careful at this point. You got to be really careful. I mean, forget about the big banks bearish bet. Again, I take it with a grain of salt. The breach of the expected move, coupled with the fact that bonds are selling off, the financials are down, and the fact that volatility futures, and there is still a big gaping hole, okay, in here, that makes me a little bit nervous. All right. Next to the docket here. And these are things, again, that are right on the forefront, things you need to be focusing on right now. Big tech gets deeply concerning. So we're going to look at the monsters of tech. The monsters of tech, again, is this conglomerate symbol that I've actually built, right? And what the monsters of tech amount to, it's just Apple plus Microsoft, plus Amazon, plus Facebook, plus Google, right? And it's on a ratio, but neither here nor there. First of all, I like to show this because I think it's kind of cool, but the monsters of tech, like I have my own little index product, and it has a market cap, and the market cap in here is close to $5.5 trillion. Pretty sweet, right? It's about $5.5 trillion. Should I be concerned about that? No, not really. Okay. What we need to be more concerned about at this point, okay, is it's not even all the monsters of tech. It's individual, okay, products inside of the Nasdaq that carry massive market, okay, cap weight, that have had incredible year-to-date performance. So if I bring up the monsters of tech, okay, and I go to year-to-date percentage, this is what I want to start with, okay? The year-to-date percentage. What is deeply concerning at this point? So this is all your big tech companies here. I'll get to NVDA in a second. NVIDIA is not really part of the monsters of tech, and I'll explain that as well. But what's deeply concerning over here is that the monsters of tech are actually up some 33% on a year-to-date basis. Okay, that's good. Yeah, but the QQQ is only up 21%. So you're actually finding out real quick that pretty much the Nasdaq having any upside whatsoever is largely predicated on nothing but these monsters of tech. Then I actually want you to look at the individual performance of some of the monsters of tech. All right, so we start looking at Microsoft. It's up 35%. Okay, Apple. Apple's not a performer. Ironically, not only is Apple not a performer, it got smacked today. Okay, I mean, Apple's down by 3%. It's 15% on a year-to-date basis. All right, Netflix is not really one of the performers in here. We start looking at Amazon. Now, Amazon's not really a performer, only up 8%. Okay, so you want to know why I'm deeply concerned? Well, it comes down to this. So Apple isn't doing much on a year-to-date basis. Amazon's not doing much on a year-to-date basis. So you're telling me that the monsters of tech are holding up the entire Nasdaq? Absolutely are. They're up 33%. Yeah, but it's really what? It's Facebook, which is 40%. It's Microsoft, which is 35%. Start looking at Google. Okay, take a look. Google got hit today. Still up 63% year-to-date basis. Okay, and that's it. I'll stop right there for a second. So Google, okay, what? Facebook and Microsoft, those are by far, in a way, your top performers, okay? And that is where the performance of the Nasdaq is being driven. The market cap of these underlyings is absolutely massive, okay? And literally causing, I mean, you take a look at something like Google at 63%, and I'm not telling you anything you couldn't, dig out yourself. It's almost a $2 trillion market cap, all right? It's almost a $2 trillion market cap. And the reason that I'm bringing this to fruition, and then I'll bring up NVIDIA here, because NVIDIA has become a player in the room, right? NVIDIA is up 71%. NVIDIA didn't mean anything at the beginning of this year. Now, okay, now it's over what? $560 billion company. But the reason that I have NVIDIA up there, it has 40% implied volatility, right? Meaning like it's almost double the volatility of Google. So instead of acting like a $600 billion company, NVIDIA is more acting like, a $1.2 trillion company. So you have to actually put NVIDIA in the game over here. The entire Nasdaq obviously rests on the market cap of a few underlyings, okay? And these few underlyings right now are all ultimately in play. Now, what we anticipate we would see in this case, if we see any more sell-side activity in the bond market, you got to look at the top performers, NVIDIA, Google, Facebook, Microsoft. Watch them very, very carefully in the days to come for sell-side activity. The sell-side activity, okay, in literally these four products is actually enough to absolutely rock the Nasdaq. It'll spill over into the S&Ps, okay? We'll get a higher correlation coefficient, okay? And the volatility futures will turn around and flip over almost immediately. We appear, okay, again, to be on a verge of a little bit of sell-side activity right now. And one of the things I'm trying to key into on this weekend's update is this is some mild selling, but it can turn into some really, really massive risk predicated again on the entire marketplace now holding on basically because of four underlyings. And, you know, and then there were literally four underlyings that are actually holding up the entire, okay, Nasdaq. And again, what occurs when you sell these underlyings is it'll actually underperform in the Nasdaq, which will start sucking down the S&Ps. And then we start to spiral a little bit out of control as there's mutual fund redemptions, and I can go on for about a half an hour about how that trade would actually spill over. It's interesting to see, though, okay, the top performer pretty much out of these products today happened to be none other than NVIDIA. Of course, though, NVIDIA, if we bring up auto expected moves, NVIDIA actually hit the lower edge of the expected move twice earlier this week and just rebounded. All tech, though, pretty much across the board, down other than Facebook, which is having a decent week. Again, watch these four products coming into early next week. I think they're absolutely critical, and I think we've actually hit that kind of critical juncture. All right, next, last but definitely not least, the SPX expected move. We've actually come to the perfect time to actually discuss SPX and the expected move. Why? Because this is exactly when we decipher what is the anticipation of movement for next week. All right, first and foremost, next week is what we term triple witching. That is when, you know, your futures contracts, they're going to roll over. Obviously, there's expiration inside of the SPX. There's a primary expiration inside of the SPX. So you get index expiration, you get futures rolling over, equity options expiring. I mean, expiration's no big deal. It happens every week now. The expiration that we look at, though, happens to be the PM settlement. Cruise over to the PM settlement. I love it. Okay, we're going to have an expected move of 115, okay, roughly 27. That's something I'll actually plot on the chart. What I want to point out on this particular front, the previous week, we saw a plus or minus $50 expected move. However, that pertained to a 4-day trading week, right? So a 4-day trading week. The week prior to that, we were actually plus or minus approximately 57. That was a full 5-day trading week. Where are we going to come into? We're going to come into literally double that. So get ready to rumble in this next week. All right, $115 expected move. Watch, okay? Watch the correlation coefficients out there. Are bonds going to continue to sell off? If bonds sell off, high probability, okay, that it spills over into tech. It spills over into a tech. You watch four particular underlyings. Those, okay, and those alone are enough to actually cause the entire S&P 500 some fairly significant damage. And you can see, listen, volatility has come up and come up substantially. We actually look at the very short term, okay, S&P options. Check this out. We've actually slightly inverted here. When you look at the latter portion, of course, of next week, you're up to almost a 23 vol, okay? And then we actually flip over and mellow out after that. So therefore, there is a slight volatility inversion effectively playing out inside of the S&Ps, which amounts to the risk, okay, is coming. The risk is now. Let's see if some of these other factors play out. Again, the most critical one, bonds selling off, flipping over the volatility futures, then be off to the races inside of the monsters of tech. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.